Whoa, we have some pretty urgent information to share with you. Someone with a large position in Tesla just bought a lot of insurance. If you don't know what insurance is in our markets, then you probably know this term better. They're called puts. Now, there could be other forms of insurance as well, but options were originally created to hedge long positions. Options can be used in a speculative nature, or options can be used as they are designed, as insurance. And it looks like towards the end of the day today, there was a lot of insurance that was just bought on Tesla. So what could be coming next and what is in store for tomorrow? I think you need to know this. But let's start off with this massive new position. I mean, this really caught my attention because according to Ortex, there was over $30 million worth of options bought today in Tesla by big money with a positive order value of 1%. Okay, that's pretty dang negative for any given day for Tesla. An up day, a down day, a sideways day, big down day, doesn't matter. 1% positive order value is bad. And when I take a look at what this option buyer did, it's huge. So there's quite a few different trades here that we need to look at. And we're looking down here in the left-hand corner of your screen. You have all of these options, these huge trades, are expiring June 21st. And we'll speak on the importance of that in just a moment. But judging off of what I can see here, it looks like these options were bought, not sold. If they were sold, that would have been much better. But they actually look like they were bought. So you have a June 21st 240 put. This was it 800 of these were bought for $5.07 million. You have a June 21st 250 put bought for almost $6 million. You have a 255 June 21st put bought for $1.2 million. A June 21st 266.67 put for $4 million. You have a 250 put again for July 21st, bought for almost $6 million. And check out the largest trade of all. June 21st, 276.67 put for $11.61 million. Okay, couple things that stand out here. June 21st is very short term to be throwing out, what is this? Call it 12 million, 16, 17, call it 24 million, call it over $30 million of short-term option protection. I mean, let's just be honest. You don't see that any day. Now, what really catches my attention about this is the June 21st expiration. There's not a lot of time, but it does cover one major event, and that is Tesla's shareholder meeting on June 13th. Now, it's possible that this big investor that made this trade, and we'll look at how many potential shares this investor may own as well and what the break even is in just a moment, but it's possible that they think maybe we're just going to get some selling between now and then. And maybe they just want to hedge out their position before June 13th. That's possible. And that's probably the most likely scenario. Or it's possible that maybe they know or they strongly think that the vote's not going to go the way shareholders need it to go. And as I have said many times before, if Elon's comp package is not reinstated, the stock could sell off 20-30+%. The reason for that is Elon may leave Tesla. Now, of course, I don't think Elon will leave Tesla. He kind of made a joke about that at the last conference call. I don't think it will happen. Doesn't matter what I think. The markets are basically right now assuming a 0% chance Elon Musk just up and leaves Tesla. If his comp package does not go through, then the markets will assign a greater chance that that could happen. Even a 20% chance that Elon leaves Tesla, and you're going to be looking at some material downside. let alone a 50+% chance that Elon could leave Tesla, then you're looking at larger downside. Because whether or not we like to admit it, Elon Musk, just being the CEO of Tesla, assigns a maybe 20-30% premium to the valuation of Tesla. So I took the liberty of saving you guys the boring part of this. I added up the size of these positions. How many options were actually purchased? Okay, it's 3,630 contracts. Sounds like a lot, and maybe it is. If you go ahead and times this by 100, because each option represents 100 shares, this position is technically representing 363,000 shares of Tesla stock. Now, if you times this by the current value of Tesla, call it $176.28 per share, that's going to put you at about $64 million. That's a relatively large position for hedge funds and institutions. It's not gigantic, right? It's not a Cathie Woods position. It's not a BlackRock or a Vanguard position. But for the average fund, it is quite a large position. Now, I went to June 21st expiration for Tesla. And if we look at between the 255 and the 250 puts, which are where most of these are, some are higher, like the 266, 67. If we take a look at what the break even is on basically all of these options, it's right at about where Tesla stock is right now. If you went out and purchased a $266.60 put on Tesla, your break even would be $176.74. So basically where you closed regular trading. Now, there's a couple different things to note here. That means you're basically at a 1-to-1 ratio. That means, 300, whatever I said before, 363,000 shares of Tesla is now hedged for, right? If Tesla stock falls $1, then these hedge funds are going to protect themselves $1 of losses in their Tesla position. It's a 1-to-1 ratio. So this was not a bearish bet saying Tesla's going to fall, huge upon, June 13th. It's not necessarily saying that. It's saying someone with a $64 million position in Tesla wants a 1-to-1 hedge. If the stock falls, 50% for easy math here, then this fund would have lost $32 million. Instead, now they paid, $12 million in put premium to protect a potential loss in their larger position. Now, how options work is fairly simple. Fairly simple. I say that because it's not that simple. But if you've been in options markets for a while, it might seem a little simple to you. Now, as I have said before here on this channel, market makers, they go out and take 90 to 95%, up to 99% of the back end of options. Because let's be honest, who the hell wants to sell 266, 67 puts or 250 puts, to keep it simple, and put themselves up for that much risk, right? If this hedge fund or institution is able to basically break even and have a 1-to-1 ratio here to protect their portfolio, why would any fund go out and make the opposite trade to that? Set themselves up for massive risk. Meaning if Tesla stock falls at all here, you would lose money if you go out and sell those options. So they don't do that, right? Hedge funds, institutions, they don't go out and act like market makers. Market makers have a lot of capital, and it's their job to make a liquid options market for hedge funds and institutions that want to hedge out long positions. That's their job, okay? We've established that. So what happens if you're at a break even now if you buy these options? Market makers have to go out and short Tesla stock. Yes, at about where the stock is right now. Yes, you can factor in some of the premium there, and there's nuances here like duration. But generally speaking, if you go out and you buy an option right at the money with a break even that's, almost 0%, 0.1% or so like this fund did, then the market makers have to go buy stock if it's on the call side and sell stock if it's on the put side, essentially short the stock. To offset, if this fund were to win on their trade or if Tesla stock were to fall, hedge funds and institutions, market makers, they're not going to set themselves up for massive losses, right? So they go out and they hedge. So what this actually did was cause market makers to short 363,000 shares of Tesla at the close today. And that is likely why Tesla stock is down over 0.25% here and after hours. Now, does that potentially set us up for a rough day tomorrow? It could, but it's not definitive. Now, we could get more of this activity though, and that's really the point of this video. Don't be surprised if more funds want to go out and hedge their portfolios on a 1-to-1 ratio. When they go hedge out on deep in the money puts, which is what they just did here, then, that causes market makers to almost instantaneously go out and hedge the other side, right? To go short stock. If they, go out and buy, let's say $100 put on Tesla, market makers don't have to go hedge anything. So as you see this big day come up on June 13th, I think it's probably likely that you do get some sideways trading action, if not downwards trading action for Tesla, just as options are bought as insurance and market makers have to go out and, you guessed it, short the stock to take the back end of those options. Now, there is also going to be people that go out and make speculative trades to the upside in Tesla, and maybe that can help offset some of this, but I think the biggest risk here at this point is if the package does not get reinstated, then you're in for bigger problems. But at the same time, we also got some pretty good news from Kashkari, someone that has said maybe they don't need to cut rates at all. He said this: I certainly won't pencil in more than 2 cuts for 2024. 2 cuts? That's good for Kashkari. He also said this: I don't think that weakness in the economy is needed to lower inflation. And this: I think the odds of the Fed raising rates are quite low. So why did stocks sell off today? Well, you did have this quote from Kashkari that wasn't great. He says we could stay on hold for an indefinite period of time. But it was actually this: CB consumer confidence from the US. Yikes. It says average 12-month inflation expectations ticked up from 5.3% to 5.4%. Now, yes, this is only one reading of inflation expectations, and most measures of inflation expectations are relatively stable, do not show a problem, but this is not a great trend for the Fed. And you also have Nvidia that casually added $130 billion of market cap before the markets even opened today. Where do you think that money is coming from? It's coming from Tesla. It's coming from Meta to a certain degree. It's coming from small caps and mid cap stocks. And at this point, with Nvidia that continues to go higher without fresh capital coming into markets, it's becoming a real drag on other areas of the markets. And I explained this before Nvidia earnings, that if you actually seen Nvidia meet expectations and do okay and do well, but the stock sold off, that would actually be a positive for markets, because maybe hedge funds and institutions would allocate capital to other areas of our markets and not just all in on Nvidia. But that obviously did not happen. Nvidia's 1-for-10 stock split really got the markets going. And Nvidia was up about 7% today, even in after hours, up another 0.5%. And that is also having a net negative impact to Tesla's stock. Even though Nvidia is the hardware of AI and Tesla is creating the most valuable AI software the world will likely ever see, at least in our lifetimes, you would think Tesla would trade higher when Nvidia trades higher, but so far, that doesn't seem to be working. Eventually, I do believe markets will move on from Nvidia as the hardware aspect of AI and move into real-world applicable use cases for AI. And Tesla, I think that's when you'll have your moment, right? That's when you'll have your Nvidia moment, when the markets realize all of these companies buying these Nvidia products with billions of dollars every quarter, they better make some impressive products that bring in a lot more than that, or, you know, that investment's not going to continue. So really just the overall narrative of let's buy Nvidia, forget about everything else, is very short-term thinking, because I mean, if none of these companies have successful AI products, which none of them do today, if that doesn't happen, well, consider Nvidia, you know, a dumpster fire, right? Companies are not going to continue to buy GPUs if they cannot sell products from those GPUs. So I do think the markets are a little too narrow-minded and short-term focused as of right now. I think inevitably as we get closer to rate cuts, and once we start to get some rate cuts, hopefully into a strong economy, and hopefully there's no, you know, market crash at that moment, that's when I think Tesla can start to be valued more as this revolutionary company. But in the short term, couple different catalysts upcoming. June 13th shareholder meeting, that is by far the most impactful catalyst that we are going to have, maybe out of all of these catalysts that I'm going to mention. I think June 13th is the most important one. So that's number one. You have earnings for Tesla coming around June 20th. It could be a couple days, you know, after that, but around June 20th. July 31st, I believe, will be the first cut by the Fed, and that could be a big catalyst as well. And then you have August 8th. Now, I know a lot of you guys are going to say, well, how's June 13th more important than August 8th? Because June 13th has implications for literally Elon and the CEO staying at Tesla or not. Now, whether or not you think Elon would leave Tesla or not, I don't think so either. But yeah, that could cause the biggest move for Tesla stock, whether it's to the upside or the downside. Like if Elon's comp package goes through, then I do think Tesla stock could easily have a 10 to 20% day the next day. Vice versa, if the comp package does not go through, I would expect a bare minimum 10% sell-off. And that's like bare minimum. And just so we are all on the same page here, I have not sold any Tesla stock. I've actually been buying more. In this portfolio, at least, this is the most recent buying activity I've done in Tesla is on this portfolio. I have other shares of Tesla in other portfolios that are up a lot that I would never sell anyways, unless the business really just flopped because of tax purposes. It doesn't make sense when you can just borrow against it for, you know, 5% or so. Why am I going to sell and pay, you know, 20%, 30% tax on that? Doesn't make sense, right? Topic for another video. This is the portfolio I've been buying more Tesla in, and that I really want to get like a stupid high allocation of Tesla in. You have $15,000 here in market value, down about 9.3% currently, about $1,500 in this portfolio. Average cost $194.21 per share, 85.24 shares of Tesla, with a portfolio diversity of almost 30%. So even though it might sound like I'm a super bear that maybe I sold my Tesla stock, that's not the case. And I mean, I'll show you this portfolio before and after the shareholder meeting as well. This is a long-term position in Tesla. I want to make that very clear. Whether I am bullish or bearish, I have my money on the line here. And just for anyone that you know hasn't figured it out this far, that doesn't realize what I'm saying, I am not bearish on June 13th. I am very bullish on June 13th. But could the stock go sideways or lower into June 13th? I actually expect that. Would I call myself bearish on Tesla? Absolutely not. Would I say, hey, I don't have high expectations for Tesla heading into June 13th? Probably. And that's because I understand how big of a potential downside catalyst June 13th could be if it does not go the way that we hope it does. Good news is, odds are very low that Elon's comp package doesn't get reinstated. And even if it doesn't get reinstated for whatever reason, I think odds are still low that Elon Musk just up and walks away from Tesla. I'm sure Tesla would just hold another vote, and then another vote, and then another vote until the pay package did go through. Now, your biggest catalysts are obviously going to be on Friday, like I mentioned in videos prior. You're going to have your core PCE month over month, personal spending, personal income, as well as some other data. But tomorrow, you're going to have some important data as well. That is your Richmond Fed Services Index and your Dallas Fed Services Index. You're expecting these numbers are going to be negative, but not as negative as last month. Dallas Fed Services Index came in at negative 10.6 last month. You're expecting negative 10. Richmond Fed Services Index came in at negative 13 last month. You're expecting negative 12. So the more negative these numbers are tomorrow, likely the better markets will be. If they come in better, showing the service sector is doing better than we think, then markets are probably going to fall on this news because markets think higher economic activity in the service sector means higher inflation in the service sector, which is not necessarily true, but not necessarily wrong at the same time. It just depends on what period in time you're actually looking at. So that will definitely be important tomorrow, but you will also get the Fed Beige Book, which I think will be important as well. This is a kind of report put together by the Boston Fed, Atlanta Fed, Philly Fed, Chicago Fed, Cleveland Fed, Atlanta Fed, San Francisco Fed, Dallas Fed, all these different Fed districts, and it's really like a district, like 100 miles or so out from that specific Fed area, and it basically just goes over what inflation looks like, what the economy looks like, what incomes look like, and labor markets look like in each district. So I like to read it. I like to stay kind of up to date in what's going on, if there's a shift, if things are slowing down, because it's from the Fed's perspective. Right? And sometimes you get new details like, hey, I didn't realize that was going on. I didn't realize that was going on here. It can be important. Markets can pay attention to it, but it doesn't always move the markets that big. Something I pay attention to, though. 7-year bond auction will be coming out at 1 p.m. as well. Depending how that yield comes in, that'll definitely move some things. And Fed Williams also speaks at about almost 2 p.m., 1:45 or so in the afternoon tomorrow, and that is Eastern Standard Time. So let me know your thoughts on all of this information. I would also add the S&P and the NASDAQ are trading at very high levels. Historically, ever since May of 2023, when Nvidia had its AI, breakthrough, right? That first big quarter that nobody was expecting that put AI on everyone's radar, Nvidia has always sold off around 5 to 10% before or after earnings. Nvidia did not sell off before earnings. Now, this is the first time in a long time Nvidia is doing a stock split in the midst of this AI, craze, hype, hopium, whatever you want to call it. So we're in a little bit of uncharted territory here, but either before or after Nvidia's split, you're going to get that sell-off. Now, Nvidia is set to split on June 7th. So, yeah, maybe that could set you up for a sell-off after the split, which that would be bad timing, I guess you could say, because, Tesla's shareholder meeting is June 13th. It's possible Nvidia sells off before then, though. At some point around the next week or two, expect some selling in Nvidia, and I think the markets are already getting ahead of that now and selling off before Nvidia's sell-off. And then after Nvidia sells off, if markets sell off, like you have seen the percent of stocks falling under their 50-day moving average quite a bit here recently. Just recently, you were at almost 65% of stocks above their 50-day moving average. Today, you're at 48%. So you've seen the average stock sell off. And maybe if Nvidia sells off, that could lead to a broadening out of our markets. After the split is what I would imagine. But when Nvidia sells off, you might get some downside. Again, at least on an index level, on a single stock level, well, single stocks have been selling off for the last 2 weeks or so. And Nvidia's looks like it's not slowing down at all. Even here in after hours, up almost 1%. Tesla stock down 0.3% in after hours. So you're definitely having some kind of correlation here. But again, I'm expecting some downside for Tesla heading into June 13th. I'm expecting the markets could continue to see weakness in your average stock until the Nvidia stock split. If Nvidia sells off after that, I think that's when average stocks can start to do better, because if you're a hedge fund manager and Nvidia is going crazy, you have to own Nvidia. You almost have to chase Nvidia or your clients are going to be mad at you. They're going to yell at you. They're going to take their money out of your fund. That could cost you your job. You're not going to lose your job just because you didn't want to buy Nvidia at all-time highs. right? You thought the valuation was too lofty. Good luck trying to explain that to people that think they're missing out on the next big craze, next big kaboom, okay? So when you get Nvidia actually selling off, there's not as much pressure on hedge funds, institutions to go out and FOMO and YOLO into a stock like Nvidia. And that's the premise of why you likely see a broadening out of the markets when Nvidia does sell off, which sounds kind of contrary to what you would think. You would think Nvidia at this point sells off, it's going to be bad for everything. Not necessarily true. Nvidia rallying has been bad for everything. But nonetheless, that's going to go ahead and do it for this video. Let me know what you think about this information down below in the comment section. Let me know what you think the next couple of weeks have in store for Tesla, Nvidia, and the broader markets. Do we continue to narrow like we have been for the past 2 weeks? Or can we start to broaden out, even if Nvidia does rally and continues to suck the liquidity out of our markets? Thank you for watching. My name is Michael Tyler. If you guys want to come trade with us live in real time, check out that link down below in the description of this video. We actually did just make a trade on a low-key AI stock that only has a $4 million market cap that could get some serious capital influx if the markets start to pay attention to it. One of those high risk, high reward kind of put a small amount on it. Maybe it turns into a lot, maybe it does not. Check it out if you guys want. Link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.